New data offering a mixed picture of sentiment on Wall Street. According to the American Association of Individual Investors, bearishness is at its highest level since November of 2023. On the flip side, according to the latest fund manager survey from Bank of America, Wall Street is feeling bullish. The survey showing cash levels among global fund managers to have dropped to the lowest level since 2010 as investors are long U.S. stocks. Joining us now with more, Tom Becker, BlackRock lead portfolio manager, Tactical Opportunities Fund. Great to have you here, Tom. So investors are long stocks, but they're tipping bullish in some other surveys. Where do we net out on how investors are feeling about the market near term?
Yeah, Maddie, good morning. I think the kind of looking ahead from last year, investors are really looking for kind of the fiscal policy, the changes in the new administration to bring U.S. growth up to another level. We see a continuation of the same, so kind of high nominal growth, inflation kind of a little bit outside of the Fed's comfort zone. And to us, the positioning and the narrative that we had at the end of the last year had to shift some of our equity positioning into foreign markets and also position for U.S. interest rates and financial conditions to tighten a little bit.
Where within the foreign markets are you seeing that opportunity, Tom?
Europe was actually a place that was pretty hit negatively by the tariff sentiment. So expectations around tariffs really centered around European equities. Europe's had a tough growth run over the last couple of years, but a lot of those companies are pretty foreign exposed. They sell into international markets, and they also have a lot of goods exposure. We're seeing year to date kind of broad-based commodities lift. China may be bottoming. Some positive sentiment over the weekend in China. Also some sentiment in Europe now around kind of the rearmament and kind of figuring out how to deal with Ukraine, maybe fiscal loosening a little bit. All of that, given positioning, made Europe a little bit of an attractive entry point.
Would you say that you're more bullish equities outside of the U.S. overall then? Because it's interesting, given the run-up that we have seen in U.S. equities, it's been hard to afford to stay out of them the past couple of years.
Yeah, very much so. And so I think we put a lot of weight on what's priced and investor positioning. And I think kind of some of the positioning indicators that we look at toward the end of last year looked a little bit overstretched in the U.S. And so risk return looked like some of these unloved foreign markets offered a little bit better opportunity. If you think about kind of, last year, you had the Fed deliver 100 basis points of cuts. They tapered QT. Coming into this year, it looks a little bit harder for them to be able to deliver another round of easing. Inflation's proving much stickier at 3%. We think quantitative tightening could last longer, given some of the deregulation and some of the loosening of financial markets could allow kind of the balance sheet to shrink more and further than is expected. All of that, we think, could have U.S. financial conditions be a little bit looser compared to foreign markets. That should support foreign equities.
Tom, I'm just curious, just given so much uncertainty surrounding Trump policies and what exactly the impact is going to be, how they are going to evolve here over not only the coming months, but really over the next 4 years. At this juncture, I guess, how big of a headwind do you see it potentially being to U.S. corporate earnings, at least over the next couple of quarters?
Yeah, I think the uncertainty, you kind of point to the right facet of it right here. So it is very uncertain what's going to happen in terms of tariffs, how big, against whom, also kind of the negotiations around one bill versus two bills, TCJA extension, as well as potentially some of the tax cuts that were discussed on the campaign trail. Overall, we think the lean is going to be for more fiscal stimulus. So an extension of the current tax cuts plus additional tax cuts on the margin. That is going to be kind of a little bit of fuel to an economy that's already settling at a high inflation rate, and also is going to necessitate quite a bit more bond issuance when we come into the second half of the year. We think bond investors are going to kind of take heed potentially once we get some of the legislation between the House and the Senate a little clearer about the fiscal ramifications. And I think right here from this juncture in the U.S. economy, additional fiscal stimulus could pose problems for the long end of the yield curve.
It sounds like then the problem is not necessarily the policy itself being implemented, it's more the uncertainty. Given that, would you rather have tariff news that is objectively negative for markets but is clear today versus this back and forth negotiation?
I mean, in terms of how we're positioned, we think U.S. inflation is going to stay sticky and high. So some certainty on the tariffs and kind of the amount of kind of price impact of those would be helpful. That said, I think, our expectation is that there's going to be some consolation of tariffs that is going to keep goods inflation high. Services inflation is already pretty high. And so you add those two together and you get above target inflation. I think the market, in terms of it moving on to a new narrative, as we shift away from the tariffs, I do think it is going to come to some of the things that have to get legislated. And there it's going to be pretty interesting to see kind of which trade-offs and which policies get chosen.
All right, Tom Becker of BlackRock, thanks so much for taking the time to join us here this morning. I appreciate it.
Sure. Thanks very much.